Okay, let's dive right into the central question facing every single investor today. Is the explosive growth we're seeing in artificial intelligence a real, sustainable revolution, or is it a speculative bubble that's just about to pop?
To really wrap your head around the scale of what's happening, just look at one company. In October 2025, NVIDIA's valuation blew past an incredible $5 trillion. To put that into perspective, that single company is worth more than the entire economy of every country on Earth, except for the US and China. Just staggering.
And look, this isn't just about one company's success. This AI boom is the engine, the powerhouse driving the entire economy. In 2025, AI-related companies were responsible for nearly 80% of the gains in the US stock market. It's just a massive wave of investment that's totally reshaping the landscape.
And that right there brings us to the heart of the debate. Are we seeing a durable expansion that's built on a solid foundation of real earnings? Or are we caught up in a speculative frenzy? The kind that feels a lot like past bubbles that didn't end so well? Let's break down both sides of this argument.
First up, let's look at the case for a bubble. For anyone feeling a little bit of déjà vu, well, there are some pretty compelling patterns emerging that suggest we should all be pretty cautious right now.
So one of the biggest red flags is just how incredibly concentrated the market has become. Right now, the top 5 companies, they make up 30% of the S&P 500, and the entire US tech sector is more than a third of the whole US market. We just haven't seen this kind of dominance by so few companies in 50 years, and historically, this kind of thing often comes before a market correction. Now, here's another thing that's raising some eyebrows. It's this practice called circular investment. What is that? Well, in simple terms, it's when a big AI company invests in its customers, who then turn around and use that same cash to buy the big company's products. You can see how that creates this self-feeding loop that can make revenue and demand look way stronger than they actually are. It kind of has echoes of the dot-com era, doesn't it?
And this isn't just some fringe theory, Major financial institutions are actually sounding the alarm. Both the Bank of England and the IMF have come out and warned that if AI doesn't live up to these sky-high expectations, we could see a sharp correction that would send shockwaves through the global economy.
But hold on, that's only one side of the story. Now, let's flip the coin and explore the powerful case for why this time might actually be different. The argument here is that today's AI leaders are just fundamentally stronger and on much more solid ground than the speculative companies of the past. This slide really says it all. Back in the dot-com bubble, you had companies with huge stock prices, but zero profits, tons of debt, and really weak balance sheets. Today's AI giants, it's a completely different animal. We're talking about companies backed by massive, real-world profits, incredible cash flow, and fortress-like balance sheets with huge cash reserves.
Now, I know what you're thinking, but the valuations are so high. And you're right, they are elevated. The tech sector's price-to-earnings ratio is sitting around 25. But you have to put that in perspective. At the peak of the dot-com bubble, that same number was 50. 50, literally twice as expensive as today. So, yeah, things are pricey, but we're not in the same stratosphere of overvaluation we saw back then.
And here is the crucial point. These higher valuations are being supported by absolutely phenomenal performance. Analysts are forecasting that the IT sector's earnings are going to grow by over 20% in 2025 alone. So, the boom argument is that this powerful, sustained profit growth totally justifies the prices we're seeing. By the way, if you're finding this overview helpful, please consider subscribing for more concise market updates.
So, where does that leave us? You've got compelling arguments on both sides. Well, the reality seems to be a little more nuanced. This looks like a genuine structural boom, a real tech revolution, but it's one that carries some very real bubble-like risks. It's not a classic bubble just yet, but there are definitely some threats that every investor needs to be watching very closely.
Okay, let's quickly walk through the 4 big risks to keep on your radar. First, overinvestment. Are we seeing a tech arms race that could lead to way too much capacity? Second, monetization. Can all these free users actually be converted into paying customers? Third is the adoption gap. Companies are spending billions, but are these AI projects actually delivering a return? And finally, geopolitics. The tech rivalry between the US and China is a constant wild card.
And to really hammer home that adoption risk, get this. A recent MIT report found that a mind-boggling 95% of enterprise AI projects have not yet delivered a measurable financial return. 95%.
That is a huge gap between the money being spent and the tangible results, and it just shows how early we still are in this whole thing.
If you want a perfect case study in geopolitical risk, look no further than Cameron, a Chinese AI chip maker. Its journey has just been a total roller coaster, and it's been driven more by U.S. sanctions and Beijing's policies than its own tech. After getting hit with U.S. restrictions in 2022, its fortunes did a complete 180 when Beijing pushed to replace foreign chips, which led directly to the company's first ever profit. It's just a powerful reminder of how government action can completely change the game overnight. So, with all these powerful forces and pretty significant risks in play, what's the smart path forward for an investor? Well, the key isn't about trying to perfectly time the market. It's about navigating this complex world with a clear, disciplined strategy. It really comes down to a 4-step framework. First, focus on the fundamentals. Real earnings and strong free cash flow are king, always. Second, diversify beyond the handful of big names grabbing all the headlines. Look for the picks and shovels companies, utilities, infrastructure that are actually enabling this whole build-out. Third, really dig into where the revenue is coming from. Is it durable and long-lasting, or is it just based on short-term hype? And fourth, stay vigilant. Keep those 4 key risks we talked about on your radar at all times. And that leaves us with a final thought. There is no doubt that the AI transformation is real. It's happening, and it will reshape our world. The critical question for investors, though, is whether the market has already priced in a perfect, flawless future with no bumps in the road. Ultimately, the goal isn't to predict the exact peak of this cycle, but to build a portfolio that's prepared for all the possibilities, the good and the bad. Thanks for watching this video overview on 15 Minute Investor.